Hello and welcome back to my channel of Learning Made Easy with Rohit. Today we are going to discuss the accrual accounting entries for the topic of depreciation. Now, what is depreciation? Um, Businesses buy long-term tangible assets. Okay, for example, you buy buildings, equipment, furniture, okay, any kind of machines, automobiles, anything that you would like to use in your business. Now, obviously, these assets have a useful life. Okay, useful life basically is, the amount of time where you can most efficiently use these assets to earn revenue. Now, when you use these assets lose value. And the reason, one of the biggest reason they lose value is because of wear and tear. Okay, imagine you bought a truck for delivery. Okay, the more you drive that truck, the more value it will lose over time. Now, that value that the truck has lost is basically the depreciated amount or the depreciated value. So, depreciation is allocating that lost value or that depreciated value to expense account. So you are basically expensing the value of that long-term tangible asset that you lose because of you are using the asset in the normal course of business to depreciation expense. That is basically depreciation in the most basic form. Okay, long-term assets will lose value. When they lose value, you allocate that lost value as an expense over their useful lives. Now, one of the questions that I come across when I teach students is why expense? Okay, why do we allocate that value to expense? Well, the reason is also very simple. You own an asset, you spend money to buy that asset. When that asset is going to lose value, okay, imagine you want to sell that asset after a certain time. And when you sell, you're not gonna, get the same amount that you paid to buy that asset. So all that value that is lost is your expense of doing business. Okay, it's basically the expense of doing business. Basically, you're spending that money in a different way. You're not spending cash just like you would for paying for fuel, or you would pay cash to pay for your utility bills. That's also expense, right? Fuel expense and utility expense. But in terms of depreciation, okay, you're not paying cash, but still your asset is losing value. So that lost value becomes your expense. And for that reason, this is, the depreciation is also called a non-cash expense. Means it's an expense for which you're not making any cash payment for. Okay. In accounting, you're going to come across this term, this obsolescence term, uh, many times. And obsolescence is also basically something getting obsolete, something becoming obsolete. And we see this obsolescence in assets that are technology related. You will see that technology changes sooner than a lot of other, things, right? I mean, imagine you buy a computer system, okay, which supports a particular software. Okay, you'll see that after 6 months or every or after 1 year, there is going to be an update or there is going to be a new software that you will have to basically upload on your system. Okay, and you will see after 2 or 3 years your hardware might also stop supporting your software that you purchase. Okay, so that's the reason why we see that technology related assets becoming obsolete very soon. Okay, and we are going to discuss this in one of the later chapters when we discuss depreciation in detail. Okay, so we will have ample opportunity to discuss obsolescence. For now, we will focus on only the adjusting entry or accrual entry part of depreciation. Three methods in which we depreciate. Again, in this PowerPoint, we will only focus on the first one. That is the straight line depreciation. This is one of the most easiest ones, right? Very, very easy to understand. So basically what straight line depreciation means, it means that you will allocate equal amount of depreciation to each period or year over the useful life of the asset. Okay, so I will say again, you will allocate the equal amount of depreciation to each period or year over the useful life of the asset. This depreciation method is used by businesses whose business model and the capacity more or less stays the same. Okay, there are very few fluctuations, if any. And that is the reason why they can just basically, calculate a straight line amount and keep on depreciating that amount without even thinking twice. Okay, units of production and double diminishing balance, you have the explanation on the screen. Again, I'm not going to get into that detail right now because this is not a pure depreciation PowerPoint. When a time comes, I'm going to go into detail for those two methods also. In order for us to calculate our annual depreciation expense, we use this formula. Very simple. You take the cost of the asset, okay, whatever money you paid for the asset, that becomes your cost. You subtract the residual value. Residual value is the value that you get back once you are done using the asset and you decide to sell it in open market. Okay, you decide to sell your asset after using it for a certain time in the open market, and the value that exists in the market for that asset, or basically the cash or the money you get back for that asset, is your residual value. You can also call it scrap value, basically meaning the same thing. Okay, scrap value, residual value, something that once you have used something, you decide to sell it. Obviously, you're not going to keep on holding the asset, after its uses, because it's a wastage of your space. Okay, so the best way is to just sell it or discard it. Okay, in which case there will be some residual value. In some cases, some assets have high residual value, some have low residual value, and some assets have no residual value. But high, low, or no residual value is not our business right now. Our business is to understand the formula. So you take the cost, subtract the residual value. Even if there is no residual value, this means cost minus zero. So this means you are depreciating the entire cost. If there is any residual value, you take cost minus residual value. Okay, and then you divide it by the useful life in years, and that gives you your annual depreciation expense. The reason why we subtract residual value from cost is because we cannot depreciate something that we are not using. That particular value you are not using, because the thing is, by that time you will sell the asset, you're going to discard the asset and get some money back. So you have not used it. So if you don't use an asset, you cannot depreciate. That is the reason why we subtract the residual value from the cost of the asset. I've included an example in this PowerPoint. Okay, and this is a very simple example. We don't have to use any Excel. Like, this is very simple. We'll just use PowerPoint to understand this. So on January 1st, 2024, this XYZ Corporation acquired an equipment for $50,000. Okay, they bought an equipment for using in their business for $50,000. The useful life is 5 years and the residual value is $5,000. Till now, you must understand what the residual value means. Is basically you're going to use this asset for 5 years, and after using, you're going to sell this asset, and then, when you sell it, you're going to get $5,000 back. Again, this residual value might change. Okay, but again, this is your best assumption and best opinion of the business owner or the manager. So you assume that you will get $5,000 back after 5 years. Useful life is 5 years. For 5 years, you can use this asset, okay, to make revenue in the most efficient way possible. To calculate the annual depreciation amount, you'll see, you take $50,000, subtract $5,000, because this is residual value. You cannot depreciate this value because this is the money you will get back. Gives you $45,000. This is the total amount that you will depreciate over the useful life. And the useful life in this example is 5 years. So to calculate your annual depreciation, you divide it by 5. So you divide $45,000 by 5 and you get $9,000. This is your annual depreciation amount. And you calculate your monthly depreciation. Okay, monthly depreciation is basically this annual depreciation divided by 12 gives you $750. And the reason why we divide the annual depreciation by 12 and calculate monthly is because most of the companies, if not all, produce monthly profit and loss statement. So they want to see how much revenue they made every month. So this makes them more efficient. Okay, they can make the right decisions in the right time. Okay, they don't have to wait for the entire year to see how the business is doing. So they make their profit and loss statements and obviously other financial statements to see the overall state of the business, so they can take the corrective actions or make the necessary actions to improve their business. Okay, that is the reason why you will see monthly profit and loss statements. The journal entries for this particular example. Okay, so on January 1st, you bought the equipment. So your equipment debit $50,000 and accounts payable $50,000. Now, this accounts payable could also have been cash. I mean, it does not really matter as long as we understand, why we are making a certain journal. Okay, equipment is your asset, so you will obviously use a debit entry, okay, to record an asset. And accounts payable, okay, very few businesses will pay $50,000 in cash. That's the reason why we assume in this example that there is going to be an accounts payable, means the business is going to pay the balance after they get the invoice, maybe in a month or so, or something like that. Okay, so accounts payable $50,000 credit is liability. On January 31st, you have to record your first depreciation expense entry. Okay, monthly depreciation is $750. We already know this. So depreciation expense debit. Remember, expense debit entries. Okay, so debit depreciation expense, and here you're gonna see a new account that we have never spoken before. It is accumulated depreciation, $750 credit. Okay, so I will say again, depreciation expense $750 debit, and accumulated depreciation $750 credit. I'm gonna explain this accumulated depreciation amount the account in a minute. First, let us see what happens in the two financial statements. The first one is balance sheet. In our balance sheet, you will see that we will record the equipment. Okay, so on January 1st, we recorded a debit entry. On the left side of the T account is debit, so $50,000. And on the income statement, on January 31st, you will see depreciation expense for $750. At the same time, on January 31st, you will see accumulated depreciation of $750. Now, you might be thinking, what is this accumulated depreciation? Okay, so remember, in one of the earlier PowerPoints, we have discussed this. Income statements are being made every month. Okay, January, February, March, April, and so on. And every time when you make a profit and loss statement, it zeroes out, means it starts with a new cycle. All the amounts in those accounts are going to be new based on that particular month. Means the January's revenue will be January's and the February's revenue will be February's. The January's expenses will be January's and February's expenses will be February's. Okay, you will not see a January expense entry in a February profit and loss statement. So amounts are going to change. But there has to be an account where we record the entire depreciation that has taken place. So after a year, if you want to see how many months we have depreciated this amount, because please remember, not all the assets you're going to purchase on January 1st. This was just an example so you understand. Maybe you purchase this asset in March, April, or May, or maybe in October, November. So if you open your profit and loss statement and start checking depreciation account, you are going to get confused. because that's not the only asset you have. You have many other assets. So where do you go to find out how much depreciation we have recorded for a certain asset? And the answer is balance sheet or your statement of financial position. Same thing. You go to your balance sheet and check the accumulated depreciation account for that particular asset. Because if you start checking the profit and loss statements, number one is you will waste your time. Why? Is because you will start going, checking all the statements that you have. So 12 statements in a year, you will check first of all 12 statements. That's wastage of time. And number second is some profit and loss statements are not very detailed. They are very consolidated. So they might give you a depreciation expense, yes, but how do you know that particular depreciation expense is for this particular asset? It could be for a different asset, because remember, businesses have a lot of assets. Okay, so you go to your balance sheet, look at the accumulated depreciation account for that particular asset. So in this case, equipment. So what this accumulated depreciation will do is it will record all the depreciation that has taken place over the useful life. January 31st, February, March, April. So the accumulated depreciation will increase until the day you decide to sell this asset. So it will have the entire amount. That is the reason it is called accumulated depreciation. Now, one of the other things that should come to your mind just by looking at this slide is that, well, we're looking at the balance sheet and we're looking at the equipment and we look at the accumulated depreciation. Now, where does this account go? Does it go to the asset side? Does it go to the liability side? Okay, the answer is asset side. This account, even though it behaves the opposite way of the asset, it still goes to the asset side of the balance sheet, so left side of the balance sheet. And why I say it behaves the opposite way is because remember, the assets, when you increase the asset accounts balance, it is on the debit side. And when you increase the accumulated depreciation accounts balance, it's on the credit side. So it is sort of behaving like a liability would behave. Remember, when the liabilities balance goes up, it's a credit balance. When the assets balance goes up, it's a debit balance. So, well, this account, the accumulated depreciation, its balance is going up on the credit side. It's behaving like a liability, but it's not a liability. It's actually a different class of accounts, and that is called that class is called contra asset account. Means this particular account behaves in a contrary way to the asset. It behaves in the opposite way to the asset, or it works against the asset. So every depreciable asset in your business will have a contra asset account that will be linked to that particular asset. And in this next slide, we will in just little bit of detail. So your contra asset, it will always have a normal credit balance. It will accumulate all the depreciation that has taken place. It is always seen with a companion account. So it will always be with either building, it will be with certain equipment, it will be with a shuttle bus, with a truck, okay, with anything that you're depreciating, it will always have a companion account. It will always accompany the asset that it is recording depreciation for. Okay, and it will have the sum of all the depreciation that has taken place. Now, when talking about depreciation, you will also see carrying amount. So what is carrying amount? Okay, carrying amount is basically your long-term asset minus your accumulated depreciation. So you will take the cost of the asset and you will subtract all the accumulated depreciation that has taken place, and that becomes your carrying amount of the asset. One more thing I would like to point at this point is that all this depreciation that you are seeing taking place, this $750, we will not reduce the value of the asset on our balance sheet. That never happens. With some basic accounting rules, we have to carry in the most basic circumstances, simple circumstances. general circumstances, we have to carry the asset at its book value, at the historical cost, whatever money we paid for this asset. There will be some instances where you will have to adjust this amount to the fair value, but those are advanced level concepts that we will talk when time comes. But for now, your equipment will be carried on its historical cost or its book value. You will not reduce the value of the asset because of depreciation. The asset will stay as it was. All the value that you are reducing will be reduced in the accumulated depreciation account. Okay. Now, if you were to open your partial balance sheet, okay, obviously this is not the balance sheet, but if you open the partial balance sheet only looking at the account that you want to look at, so in this case, it is the equipment, you will see this is going to look like this on January 31st. You will see the equipment is still at $50,000, but your accumulated depreciation has a credit balance of 750. Your carrying amount becomes $49,250. This is your carrying amount. This is the amount that you are carrying this asset. Okay. So when time comes for discussing depreciation, we're going to get into a lot of detail. It's a very interesting chapter, a lot of questions that I would like to show you, a lot of examples. But that will be in one of the next classes that I'm going to talk about. In the next PowerPoint video, what we will talk about is the last part of our accrual adjusting entries, and that is the accrual itself, right? So we will talk about accrual entries. Thank you for watching. In the comment section below, please let me know your thoughts about the content and what other topics you would like me to explain to make learning easy for you. Finally, please don't forget to hit the like, subscribe, and the bell icon to get the latest notification for my videos. See you soon in the next class. Till then, take care.